So it's time to look at the last statement, which to me is the most important statement of all. This is the statement of cash flows. This tells us exactly how much cash actually comes into the business and how much cash goes out of the business. Now, why is this important? Because remember that profits are an accounting entry. So sometimes a company may record that it made profits this year, but they did not actually collect the cash. The cash did not come in for a variety of reasons. It could be that the company made a sale, it recorded the profits, but it could not collect the cash. Maybe the customer did not pay, or the customer went bankrupt. So you tell me, what is more important, recording the profit or actually collecting the cash? And I don't know about you, but to me, collecting cash is more important than just recording the profit. And that's why the statement of cash flows is the most important statement of all. So in the statement of cash flows, there are three sections. First is the cash flow from operations. This tells us how much money comes into the company based on the company's business. So for example, if the company is in the restaurant business, that means that based on its restaurant business, how much cash came in from the register and how much cash went out to pay bills. And so net, we want to know the net cash from operations. So once again, this indicates how much cash inflows and outflows resulted as a result of the company's operations. And we actually use this figure to calculate the company's intrinsic value. To know what a company is worth, we have to calculate how much cash it generates from its business operations. So we only want to invest in companies that have positive and consistently increasing cash flow from operations. So this is one very important thing that we look at as investors. Now again, there are exceptions, which I've mentioned. There are certain companies that by nature of their business model, their cash flows are not consistent. For example, banks, insurance companies, commodity companies, and property developers. So for these kind of companies, we can't value them based on their cash flow from operations. And we don't expect to see a consistent growth in cash flow from operations. So for these companies, we have no choice but to fall back on the net income and sales revenue. But for all other companies, this is crucially important. The second part of the statement of cash flows tells us the cash flow from investing. So this tells us how much cash goes in and out as a result of the company's investment activities. So for example, a company may buy another company. It invests in another company. A company could buy plant, machinery, equipment. So when that happens, cash goes out. So you see that the cash flow from investing is negative. So a negative cash flow from investing is not a bad thing. It just tells you the company is using money to make investments. At the same time, if a company sells an investment, it sells a building, it sells its land, its property, what happens? Cash comes back in. So when you see positive cash flow, it means the company is selling its assets or investments. When cash is going out, company is buying assets or equipment or is making investments. This is also known, by the way, as capital expenditure or CapEx. Okay, so again, this is neither good or bad. It just tells us is the company investing in equipment, CapEx, or it is selling assets to raise cash. The next part would be cash flow from financing. This tells us how much cash comes in or out based on the company's financing activities. So what is financing? Simply, it means raising money. There are times when companies need to raise money in order to grow because they may not have enough money. So they may not have enough cash, so they need to raise cash. Now, there are two ways the company can raise money. The first way is to borrow from the bank. So by borrowing from the bank, what happens? That's right, cash comes in. So that's called a cash inflow. So is that good or bad? Well, it depends, right? Of course, if they borrow money and they use it for stupid things, that's bad. If they borrow money and use it to invest in great assets, that's good. So it really depends, right? There's no right or wrong in this case. A company can also raise money by selling bonds to investors. When it sells bonds, it kind of like borrows money from investors who buy the bonds, and they pay the investors an interest rate. If it borrows money from the bank, it also pays an interest rate. So that's the first way the company can raise money, through debt. And again, like I mentioned, nowadays companies like to raise money through debt because interest rates are historically low. Another way a company could raise money is by selling new shares to investors. So when a company sells new shares to investors, investors buy the shares and they pump in more money into the company. So cash comes in. That's also known as a cash inflow from financing. So again, company can either borrow money or sell new shares to raise money. Now, when a company sells new shares, it will usually give its existing shareholders the first right to buy the shares. So they'll tell the existing shareholders, hey, I'm going to sell new shares. Do you want any? If you want, I'll sell it to you at a discount. It's called a rights issue because they give the existing shareholders the right to buy the new shares at a discount. Now, if the shareholders do not want to buy the shares, they say, fine, I've given you the right, you don't want it, fine. They will then sell it to new shareholders. In general, do we like companies who keep selling new shares and raising money? Well, not really, because when a company sells new shares, what happens? That's right, the number of shares outstanding gets bigger and bigger. There are more and more shares that's available, which means you have to share the company's profits with more and more shareholders. So each share gets worth less. Your shares are being diluted. So for example, let's imagine that the company you're investing in has a net income or net profit of say $100 million. It makes $100 million a year. And initially the company has a total of 100 million shares. So number of shares outstanding is 100 million, correct? Okay, so if you take $100 million in net profit divided by 100 million shares, how much does one share earn? It'll be $1, right? We call this the earnings per share. So theoretically, it means that every share you own, you are entitled to $1 in profits because you take the total profits divided by the number of shares. Okay, and let's imagine that this company now, they decide to raise more cash. So they decide to sell new shares. And keep it simple, let's imagine they decide to sell 100 million more new shares to new investors. So it means that the number of shares from 100 million now grows to 200 million. So now there are 200 million shares. And assuming if the company makes the same profits, if the company makes $100 million the following year, what happens? You're not too happy, right? Because now the $100 million profit is divided into more shares, into 200 million shares, which now means that the earnings per share is 50 cents. So the one share you own is now entitled to 50 cents. So you've been diluted down, right? That's why we don't like companies to sell new shares. Got it? But of course, if you believe that the company, by selling new shares, they can raise the cash to generate even more profits and grow the pizza, even though your slice is smaller, it's a smaller slice of a bigger pizza, you're better off. So for example, if you believe that by raising cash, the company can triple the net profit. So from $100 million, the company can now make $300 million in net profit. And that $300 million is divided by 200 million shares. That would give you $1.50 per share. Right? So the earnings per share is $1.50 up from $1, which means you're better off. Right? So it depends. Okay? So just bear in mind that whenever the company borrows money or sells new shares, money comes in. It's a cash inflow. It's a positive cash flow. And whether it's good or bad depends on what they use the money for. If they raise cash to pay off debt, they raise cash to do stupid things, it's not good. Now, on the other hand, what's the opposite of borrowing money? That's right, the company can pay back its debts, can pay back its loans. So when they do that, money goes out. It's a negative cash flow. The company could also buy back the bonds from the shareholders, right? Which means they buy back the bonds and cash goes out. Now, what's the opposite of selling new shares? The opposite is the company buys back the shares from the market. They buy back the shares using cash and they cancel the shares. So the shares no longer exist. So when that happens, cash is going out. Is that good or bad when a company buys back shares? In general, we like it when companies buy back shares. Because when they buy back shares, what happens? The number of shares gets less and less. So when there's less and less, it means we now share with less people. So each share is worth more, right? This is the opposite of the previous example. So let's imagine now that the company has got 100 million shares initially. And they said, hey, we're going to buy back our shares. We're going to buy back 50 million shares using the cash in the bank. So by buying back shares and they cancel the shares, now they are left with 50 million shares outstanding. And I'm really happy because next year, if the company makes $100 million of profit, we just have to divide it by 50 million shares. So what does that do? This increases the earnings per share to $2 earnings per share. So as a shareholder, I'm better off after the share buyback. So we like companies to buy back shares. Now, of course, this sounds great, but it should only happen under two conditions. Number one, a company should only buy back shares if it is doing well. If its sales are rising and its profits are rising, it makes sense to buy back shares to reward shareholders. And it also makes sense if the company's current share price is undervalued. It makes sense. But if the company is losing money, the company is not doing well, they should not be buying back shares. They should use the cash in the bank to improve their business, right? Or if the company's share price is currently overvalued, they should not be buying back their own shares. They should in fact use the cash to buy the shares of another company that is undervalued, that could be a competitor, to take over the competitor. Follow? Make sense? All right, so that's how it works. So basically, out of these three parts of the statement, what we're going to be focusing on the most is the cash flow from operations. We want this to be, again, positive and increasing consistently. So to look at the statement of cash flows, we can look at Reuters or Yahoo Finance. So whatever, doesn't matter, right? So again, let's go back to Reuters. And again, go to financials over here. Click on financials and click on cash flow. Again, financials, cash flow, and we want to look at the annual cash flow to ensure it's increasing consistently, right? So which one do we look at? There's so many of them. This is the one we're interested in. Cash from operating activities, that's the one. So again, you can see for the last 5 years, it's been increasing 29 billion, 33 billion, 39, 43, 52. So we want it to be increasing consistently for the last 5 years. Now you can see over here, this is the cash flow from investing, which I talked about. And you can see that it's negative. So is negative bad? No, it's not bad. It just tells you that Microsoft is using its money to invest by buying more plant, machinery, equipment, investing in R&D. So money is going out from investments, as you can see over there. If you scroll down lower, you can see cash from financing. So you can see that it's negative, negative. So is that bad? No, it's not bad. It's good because it means that the company is probably using its cash to buy back shares, right? Or is using cash to pay back its bank loan. So that's a good sign, all right? So there you go. Now, you can also look at this from Yahoo Finance. So again, under Yahoo Finance, we go to cash flow. And you can see the latest cash flow in 2019, right? You can see this entire part is used to calculate the net cash from operations. So this is the cash flow from operations over here. And you can see it is increasing consistently as well. from 2016 to 2019 is going up. You read from right to left, right? Again, this is the cash flow from investing, right? You can see it's negative, which means the company is investing in stuff. And finally, again, the cash flow from financing. I think this is the one, but it's been cut off. Yeah, for some reason they cut it off. That's right, this is for financing activities, which means it's either buying back shares or paying back its bank loan. Now, another figure that analysts look at is what we call free cash flow. All right, free cash flow. So the free cash flow is calculated by taking the cash flow from operations and deducting the capital expenditure. So you take the cash flow generated from the business minus the capital expenditure from investing. What is left? What's left is the free cash flow. There we go, right? And we always want to see that the free cash flow is positive. It is positive and rising. That's the best, okay? Now, why is it important for a company to have free cash flow? Because with this extra cash, what can it do? That's right, it could pay dividends to shareholders. It could use the cash to buy back shares, all right? But if the company has negative free cash flow, what does it mean? It means that the company may generate 50 billion in cash flow from operations, but is spending maybe 70 billion on capital expenditure, which means it is spending more money on investing than it's making in its business. And that will cause a negative free cash flow. And if free cash flow is negative for too many years, what happens? The company will run out of cash. No more cash. And when the company has no more cash, what does it do? It has to raise money by selling new shares and taking bank loans, which we don't really like, right? Okay, so that's why free cash flow is really important as well.